Good afternoon and welcome to the third series of the education webinar series hosted here by ProVise. My name is Oscar Skjaerpe, and today we'll be discussing some more topics when it comes to education planning and some of the changes we can see going forward. We'll be reviewing some slides today, and at the end we will open it up to a live Q&A question section. So if you have any questions, please drop those in the Q&A chat box below. With that, we'll get started. Like I said, my name is Oscar Skjaerpe. I am one of the certified financial planners here at ProVise Management Group. I've been here for about 5 years now and graduated from the University of Florida. Go Gators. ProVise is a local RIA firm here in Tampa and Clearwater, Florida. We service more than 1,000 households in the United States, serving over 30 states, as well as over 1,100 households. We service needs when it comes to financial planning, estate planning, tax planning, all the way to education planning. So if you have any questions in that realm, we are happy to answer them. In today's agenda, we will be talking about a few different topics, primarily the increasing costs of college. We'll be diving into FAFSA and the CSS profile. We'll also be talking about a few tips of how to personalize your education plan. And then we'll also, again, have that live Q&A at the end as well. The first topic we'll be discussing are the financial challenges when it comes to education planning. As you can see on this screen, public schools and private school college tuitions have gone up significantly since 2004 and even before that. For public schools, it's up more than 170%, while for private schools, it's up 144% since 2004. Now, most people, when they think about colleges, they are thinking private versus public. This is what we call the traditional or old way of thinking of college planning. Really, what we should be doing these days is looking at it from a financial lens. And what I mean by that is that we really have to take the whole picture into account when it comes to merit-based, needs-based, loans, and financial circumstance. So that is really the new way of thinking. We can't just be looking at public versus private schools anymore. More and more colleges are offering flexible pricing or merit-based scholarships. So that's something we have to take into account when we're looking at the grand picture when it comes to education planning. Like I said, some of the challenges that families are facing are the triple-digit tuition increases since 2004, again, up more than 140 or 170% since then, and even further if we go further back. As far as loans offered by the federal government, these are about at the same level since when parents went to school 20, 30 years ago. So really the amount of available funds there from the federal government has not kept pace with the rising cost of tuition. Also, there has been a decrease in the asset protection allowance that is granted towards parents when it comes to education planning. And what I mean by that is before there used to be a $53,000 allowance of excluded assets, meaning anything above and beyond your retirement accounts and your primary living home, you could still exclude about $53,000 worth of assets. Nowadays, everything else is included. So if it's not in a 401k, IRA, or your primary living, it will be included as part of your assets when looking at your FAFSA and CSS profiles. Next, we'll look at the financial aid picture. We're going to be looking at the 3 different types of financial aid. These can be categorized into need-based aids, grants, and scholarships, the merit-based grants and scholarships, as well as loans. We'll be discussing the top 2 there more so than the loans because we've discussed the loans more in our previous webinars. As far as the sources of financial aid, there are several different categories there that we can cover here. There are financial aid offered by the U.S. federal government, by the states, by the colleges, as well as nonprofits and private organizations. Banks and credit unions do offer loans as well. However, the most common categories we should be focusing on are the U.S. government, which will offer grants and scholarships as well as loans. They have payback programs that can be taken advantage of. On the state level, there are grants and scholarships offered there as well. On our screen, you can see the New York's tuition assistance program. but one here in Florida would be the Bright Future program. So based on the student's merits, you can earn a scholarship through the state as well. As far as the need-based aid forms, most people will be familiar with the free application for federal student aid, or FAFSA. However, a newer one is the College Scholarship Service Profile, or CSS profile. This one has become more popular these days, especially among private schools. As far as FAFSA and which assets and income are counted towards that, as we go down the list here for parents, only about 5.64% of assets are counted towards the FAFSA calculation. So assets do not play a huge part when it comes to what the parents have. However, income is really what determines your FAFSA score. So if you're a household where the parents have earned a healthy living, that will impact your FAFSA score. From the student's perspective, the assets do count more. However, on average, most students do not have a ton of assets that would count towards a score. I would advise that students with a trust in place should be aware that the trust will count towards their assets. For students, the income will be up to 50%. However, again, students typically do not earn such a high living, so it won't count as much. One nice change that has occurred recently is that grandparents, they are neither assessed on their assets or income. So 529 accounts, for example, held in their name, in the grandparent's name, will not be counted on the FAFSA form. So that is a big advantage when it comes to generational planning. Some of the changes we've seen to the FAFSA in 2024. The first one will just be a labeling change from the expected family contribution to student aid index. Again, this is just a labeling change, so nothing you need to be aware of, but just know that the student aid index is what we use going forward. Number two, you no longer receive a discount for families with multiple students in college. You used to get a discount, say you had 2 or 3 children attending a college at the same time, you would receive a discount for that. That is no longer the case. So you will get the same discount whether you have 1 or 3 children in college at the same time. So not an advantage for parents there. The third one, the divorce formula. So this has changed to only account for the parent that is providing the most substantial financial aid to the student. It does not have to be for the parent who claims the student as the dependent. FAFSA is very unclear on this, so it's up to the parent's discretion to decide which parents should apply for the FAFSA, since only one parent will be applying on the student's behalf. Number 4, also a disadvantage here, small businesses and farming exemption. So the exemption has been removed, meaning that more assets for people who own small businesses or farmers will be counted towards FAFSA. So this could be things like inventory, capital equipment, anything under that realm of items could be counted towards the FAFSA calculation and lower the amount of aid that you get. Number 5, again, like I mentioned, grandparents' contributions no longer count towards a calculation, and this is to our advantage, as this means we can do some more planning with the grandparents and put assets in their names instead of the parents or the students. Here's a quick overview of the need-based versus merit-based aid. Going down the line, how it is determined. For need-based aid, the FAFSA and the CSS profile will determine how much aid you get there. On the merit-based side, it will be determined by each individual college, and this will be based on the different aspects that the college deems beneficial or worthy as far as receiving aid. As far as the type and source, on the need-based aid, it will come in the form of grants or scholarships from the college. And on the merit-based aid, it will be the scholarship from the college as well. Duration. Typically, the need-based aid will be reevaluated each year, so you do have to fill out the FAFSA and CSS profile each year to continue to receive that aid. On the merit-based aid, this typically lasts for 4 years. I would encourage you to ask the college whether it is for the full 4 years. Typically, there are some factors in place as far as keeping a certain GPA or taking certain classes at the university as well. So lastly, which colleges offer it? Pretty much all colleges except FAFSA and CSS profiles. So on the need-based side, you're covered there. On the merit-based side, not all colleges offer merit-based scholarships. These days, a lot of colleges that are in the higher ranking subset don't feel the need to offer such high merit-based scholarship because they still receive the same amount of applications from in-state and out-of-state students. So this varies fairly greatly. So I would get in touch with the individual college that your student is applying for. Merit-based scholarships. Here are a few of the different factors that determine how they do this calculation. So first and foremost, demonstrated interest. This will be based on where you live, how much you've reached out to the university, have you gone on their tours, how much interest are you actually showing in attending this university. This is, of course, very subjective, but there's a $3,000 potential there that can be gained. Do you live out of state? If you do, some universities will grant you additional money for that because they know it's going to be more expensive for you to come and attend their university. Number 3, transcript, very important. Coming out of high school, you get about $62 worth per A that is on your transcript score. So make sure to keep those grades up. Number 4, rigorous class, very similar to number 3. For every AP or IB class that you've taken, you can expect roughly $400 worth of merit-based scholarship money. Letter of recommendation. This comes in very handy if you have a previous employer or an alumni that can vouch on your behalf. We highly encourage you to submit those even if they are not necessary. Next, we have ACT score. This also goes for SAT scores. If you have an above average score, obviously we encourage you to submit those to the university, even if they don't require them, just because it can grant you additional merit-based money. And then, of course, we have the FAFSA and CSS profile. Just by filling these out, the university receives plenty of information on your behalf and typically grant additional money that is merit-based and not just needs-based. So, with all that being said, we do have to work on putting a plan in place, so we'll take a couple minutes to discuss what goes into that outline. Building a strategy to pay for college. What is the 4-year plan? So the discussion here really revolves around not just paying for the first year of college, but to pay for as much as possible. So you, your financial planner, and your student have to think about, does it make sense to pay for as much as possible year 1, or would it be smarter to take smaller sums for each of the 4 years? Do we want to plan for a graduate program? If so, we certainly have to start earlier or save smarter and more early on. So these are all conversations you should have with your financial planner. Typically, we like to plan for all 4 years of college, even if that means you don't cover the full cost in the first year or 2. It just leaves you with more flexibility down the line for student loans, for merit-based scholarships, and those sorts of things. One of the key pieces when it comes to planning is to involve your children. And we really see this as a 2-step process. We encourage parents and grandparents to start openly discussing the upcoming expenses and opportunities that come with attending college. We say as early as middle school is a good time to have that initial conversation. We realize the student more than likely does not know where he or she wants to go at this point, but exploring the topic and having the discussion around what their interests are and where they might want to go, whether that's a public or a private university or a trade school somewhere. There are great programs across the country, so either option is good. Again, we like to revisit the topic in high school as they're getting closer to that college age. They may have a better idea of where they may want to go, what they might want to study. And again, that will help clear the picture when it comes to our planning purposes. Especially if you have a 529 plan, this comes in very handy because you may want to start reallocating that account to be more conservative at this point, just because you don't want to take as much risk later on in the student's lifetime. I also wanted to quickly cover some of the changes that have happened to the 529 savings accounts. The first one being the $10,000 lifetime limit to pay back student loans. This is on a per beneficiary basis. So if you have a 529 account and you come out of college and you still have student loans, but there is a balance in your 529 account, you can take up to $10,000 and pay down that loan. So a great advantage there for those who have student loans. Another strategy there, which some parents have used, is that they've funded their child's 529 account, but they themselves actually have student loans. They could technically change the beneficiary to themselves and pay down $10,000 worth of those loans and then change the beneficiary back to the student. There is some paperwork involved, but another way to save some money on those interest payments. The second one we've discussed before in our previous webinar, but if you come out of college and you do have excess funds in the 529 account, there is the option to roll some of these funds into a Roth IRA. This will help the student kickstart their retirement savings and is a great way to avoid some of those penalties as well for non-education related expenses. However, there are some other factors that need to be taken into account, like having the account open for 15 years. And there are limits as far as how much you can take out and roll into that Roth IRA. But all things you can discuss with your student if that time comes. The last change that we've seen to the 529 plans is that you no longer need to claim all the 529 monies. What I mean by that is that typically in the past, you would have had to tell the FAFSA form how many 529 accounts are out there, even for siblings. These days, it's just for the student in question. So those other assets will not be counted as available on the FAFSA form, which is a good thing. So that should help improve your FAFSA score as well. With that being said, I'll open it up to questions. I know that was short and sweet. I'm trying to get everyone out by the end of their lunch break. So if you have any questions, please use the chat box below, as I'll be answering them as they come in as well. Okay, perfect. Well, like I said, use the chat box below if you have any questions. If there are any questions that come in that I'm unable to answer or that you'd like to ask me personally, you can shoot those over to my email as well. We did have a couple of questions come in before the webinar started. I had a couple of clients reach out about a few specific questions, so we'll cover those first. Again, if you have any questions, feel free to add those to the chat box. So the first question that someone submitted was, when is the income and assets assessed for the FAFSA and CSS profile? That's a really good question. The way income is assessed now is that it is called the prior year to starting college. So what that means is when calculating the FAFSA and looking at the CSS profile, they will look at the spring of the sophomore year in high school. So 2 calendar years before you start your college, or the student starts their college career that fall. One of the things that I didn't mention earlier was that pre-tax contributions to retirement plans for parents do not count as income in that year. So if you are a parent who has a 401k plan or another retirement plan through work and are not maximizing that for whatever reasons, if you do increase that contribution, it will lower the amount of income that is reported on the FAFSA form. So that can be a good way to reduce your income and also increase your savings, of course. Of course, I would recommend that you look at your, monthly budget and cash flow and speak with your financial planner before you increase that contribution, just to make sure, you're in the green still. But that was a great question. As far as how assets are looked at, it is the prior year, so only 1 year before. So some advisors may advise you to start moving assets out of your estate into either a child's estate or out of the family entirely. Although I typically wouldn't recommend that. As we looked at it earlier, income really is the biggest driver when it comes to merit-based or needs-based aid. So really focusing on that income and reducing that as much as we can would be the goal there. Next, we also had a question about the timing of the whole college process. When should you start taking SATs, ACTs? When should you start looking at colleges, applying for colleges? And I found a great resource by JP Morgan. They post a yearly slideshow of for education planning. So I figured I'd take a couple minutes just to review this for you. So starting in the high school junior year, in the fall, really in September and November, that's when the college search should really begin for earnest. The students should start taking their SATs, ACTs later that winter, formulating that college list of places to either go visit again or start narrowing down that list may make sense. If the student was not happy with the ACT, SAT scores, then retaking those tests certainly makes sense, and also scheduling college visits. In the March to May, timeline, taking your AP exams, writing those college essays, and of course, getting recommendations from college counselors, teachers, and getting some letters of recommendation. That summer to fall, finalizing that college list certainly makes sense. And then opening or starting the common application that August as it opens then. You can also start begin to apply for scholarships at that point as well. Now we go into senior year. That October, the FAFSA and CSS profile opens on October 1 now, which is earlier than it used to be. So that gives parents more time to fill out those forms, as it does require quite a bit of information regarding your finances. So I'd recommend you start those straight away in October. That November, students are able to apply for early decision / early action. If there is a university that the student really feels passionate about, then this is a good opportunity to showcase that to the university. This will be one of your last opportunities to retake the SAT and ACT. So if the first 2 times didn't go so well, now is a good time to buckle down. That December through February, again, looking at the early decisions, considering which schools you would like to go to, and then also submitting the regular decision applications. So early in the year of the spring of high school senior year, that would be a good time. Then March through May, make the final decision and pay the deposit on whatever university the student ended up at. Of course, the student will be taking their AP exams, and then also very importantly, finalizing the loan applications at that time. So that is the general highlight as far as the timing of the college process. Of course, there are many steps in between and before and after, of course. So the earlier you start that process with your student, the better, especially visiting colleges, talking about what majors or what careers they might be interested in. Those are all conversations, again, you should start having in middle school and early high school as well. One question we just had come in: should my child take the ACT or SAT or both? Typically, I'd recommend that they take both just to be safe. There are some universities these days or most universities accept both. I know in the recent years, some universities have gone away from the whole testing thing, but many of them are now going back to it just because it is a very tangible number that they can go and reference as far as the students' knowledge, abilities, and so forth. So I would recommend that you have your student take both. Let's see, any other questions? One thing I also wanted to mention, and if you're interested in this, you can send me an email. If you Google online the SAI calculator, it allows you to plug in your current income, assets, and really gives you a pretty good view on what your SAI score is, which again is referencing how much needs-based aid you may be eligible for. So another thing that I would recommend. Another side note, I mentioned it earlier, when it came to grandparents' income and assets not being assessed when it comes to FAFSA scores. Again, withdrawals from grandparents or other non-parents accounts will no longer be reported as student income. So very important there. If you have other family members that are willing to participate and contribute to your child's education, they are in a stronger position to do so than probably the parent or the student are. So another thing to consider. Okay, I don't see any other questions right now, so I think we'll wrap it up. We will be posting this webinar along with the slides on our websites if you want to get them ahead of that time. please just send me an email and I will go ahead and forward the slides to you. If you have any other questions related to education planning or any other financial planning, we are here to answer those. So please feel free to shoot me an email and we'll close it up there. Thank you.